Hello, in this video, we'll be going through how to prepare a pension worksheet. So right here is a typical pension worksheet laid out, and I have it in debit credit format. And across right here on these rows, I have the typical accounts that are used in pension accounting. And so we have our pension expense, cash, OCI related to prior service cost. And then here on columns G and H, we have a memo record. And these are really keeping track of the projected benefit obligation account and the plan assets related to your pension. Now, you will have these accounts on the general ledger. However, when it's reported in the financial statements, we net the two, and either your pension is overfunded, which means your plan assets are greater than your projected benefit obligation, or it's underfunded where your liability is greater than your plan assets. And the way it's presented on the face of the financial statements is a net number, whether showing it's overfunded or underfunded. So that's why we have in this column F, this pension asset/liability amount, which is really just the sum of the projected benefit obligation and the plan assets, again, using debits and credits. So let's start with our 12/31/2025 balance. We're given our PBO balance and our plan asset balance, and then we're given right here this information for 2026. So let's start. We have plan assets on 1/1/26 is $111,000, which is right here in this under the plan assets column. And then we're told that the projected benefit obligation at 12/31/25 was $112,000. So when it tells us that that's the balance, we know it's a credit balance because this is a liability account. Let's continue and say it tells us that, well, first let's look at all these items that we have. We have annual service cost, a settlement rate. We're told that our actual return on plan assets is equal to our expected. We have contributions that were made into the plan by the employer and some benefits that were paid. And we have some total prior service cost that's effective 1/1/26, and it's estimated that there's a 5-year average service life of the employees. So let's tackle this $80,000 first. The prior service cost. So the prior service cost total is $80,000, and that is actually going to increase our projected benefit obligation, and the other side of the entry will go to OCI. So if I'm going to go here, this is the best way I could figure out how to do this, is right here, I have a credit to projected benefit obligation for 80, because I have to increase my PBO, and the other side goes to OCI, other comprehensive income, which closes out into our accumulated other comprehensive income at the end of the year, and that is presented on the balance sheet under this shareholders equity section. So now when I look at row 31, I have a revised balance for 1/1/26, right? I have a revised projected benefit obligation balance, starting balance of $192,000. Now I think let's start our other items. Let's go to our annual service cost is $9,500. And if you recall, that's the annual service cost is just the additional cost incurred every year that's going to increase our liability that we owe to our employees when they retire. And it makes sense that it increases because it means that the employees have earned another year of service for retirement purposes. So here, what we do for service costs, we're going to debit the pension expense and credit projected benefit obligation. Okay, we're told the settlement rate is 10%. Settlement rate is the same thing as interest rate. And because the projected benefit obligation is a long-term liability, we need to accrue the interest rate. And the way we accrue that is we take our interest rate or settlement rate multiplied by our beginning of the year PBO balance. So now be careful because we were given a 12/31 balance of 112,000, but we increased it for the prior service cost for 80,000. Oops, I forgot to put this right there. And that's just I'm just going to call that prior service cost, not amortization. And so our revised beginning balance on 1/1/26 is 192,000. So we're going to take the 192,000, multiply it by the 10%. So if I just go like that, that's going to be $19,200, and I'm going to debit pension expense for $19,200 and credit my PBO for $19,200. Now notice all these are under the pension expense column because we're going to add them all up so we can just sum up one journal, all that account into one journal entry, and you'll see what I mean at the end. Next, we're told our actual is equal to our expected return on plan assets, 11,100. So if we have actual and expected, it's the same thing. So our plan assets have increased, right? That's what our actual return is, by 11,100. And then, oops. And then the credit would go to pension expense right here. So here we have the credit to pension expense. Next, we have some funding contributions. This means that the corporation or the employer has funded the plan assets by $20,000. So our plan asset for contributions is going to increase by that $20,000. So I'm going to show that. And they paid it out of their own cash. So they're going to credit cash for $20,000. Next, benefits paid to retirees during the year was $8,000. So we have paid now our benefits to the retirees, which would lower our projected benefit obligations. So we're going to debit the PBO, but we're not going to credit the cash. What we're going to credit, we're not paying that projected benefit obligation with cash. We're actually paying it with the plan asset funds, which is held in a different legal entity. And so for corporate accounting purposes, the entry when a benefit is paid is debit the PBO, and then we reduce our plan assets by the same amount. So credit plan assets. The legal entity, the plan assets, will actually pay out the cash to the retirees. Then we have our prior service costs, so we account for the $80,000 on 1/1, but it tells us that there's a 5-year average service life, and so we need to spread out this $80,000 into pension, amortizing into pension expense over that average remaining service life. So if you take the 80,000 divided by 5, that gives you $16,000. And the way we're going to do that is we're going to debit our pension expense for $16,000, and then we're going to start amortizing that out of OCI, prior service cost. So we're going to credit our OCI, private service cost. Now I'm going to show you the journal entries right here. This is just the sum of all columns. So for pension expense, it's literally the sum of all the items that hit the pension expense for the year. And then for the balance sheet items, just make sure don't pick up the beginning balance, right? Well, OCI is a bad example, but here for the projected benefit plan that already had a beginning balance, we're only going to pick up in our journal entries the amounts that affected the current year balance that we actually are creating journal entries for. So if you look at this, our projected benefit plan has a total of credits for $100,700, and our plan assets has total entries for debit $23,100, and netted together, if I add these two journal entries up, and you look right here, it's a net credit for $77,600. So when I unhide the journal entry, I have my pension expense debit $33,600. I have credit to cash for $20,000 right here. I have a Overall debit to OCI for prior service costs for $64,000 because we had to increase, we had to debit our OCI for the 80, but then we start amortizing it down for 1/5 of that. And so I have a net debit to OCI for 64. And then I have a net journal entry to the pension asset of a credit of 77,600. Now let's look at our pension reconciliation and to see, are we underfunded or are we overfunded? So let me just show you. So our ending balance for the ending balance for, oh, I didn't do that. I didn't. Here we go. Here's the ending balances for our balance sheet accounts, right? Because they roll forward. So the ending balance for the projected benefit obligation is 212,000 credit. Our plan assets is 134,100 debit. So we have a net credit of 78,600. So in this situation, our pension plan is underfunded, right? We owe more than we have. Okay. Let's go to our 2027 amounts activity. So I just rolled forward in row 41 the 12/31/26 balance sheet items from the prior tab. So we have our beginning plan assets is 134,000 and our projected benefit obligation on 1/1/27 is 212,700. So let's start going through the items. Our annual service cost is $13,000. So that's going to be debit pension expense, credit projected benefit obligation right there. It tells us on row 6, our annual service, row 7, our settlement rate is 10%, and that is going to be 10% times our beginning projected benefit obligation, which is 10% times 212,700. So we're going to debit pension expense 21,270 and credit the PBO by that same amount. It tells us our actual return on plan assets is 12,000. But then I'm going to go here to row 9 and look at the expected return on plan assets. So if our expected return on plan assets is 13,410, what we're going to do is we're going to debit our pension expense, credit pension expense and debit our plan asset. And next, what we have to do is we have to compare that to our actual return. So if we're going to look here on the side to the right, I just want to show you, we were told that our expected return was 13,410. We could have just had, oh, our settlement rate is expected to be 10%. Then we could have also taken our beginning balance of our plan assets, multiplied by 10% and gone that amount that way as well. We're told actual return is 12,000. Again, we could be told that the actual return is a certain percent, and that would be that percentage times the beginning plan asset amount. So now we need to reduce, we've increased our plan assets by that 13,000, but it should only be 12,000. So we need to reduce our plan assets by that $1,410. So here's my reduction to the plan assets. So if I just sum up the actual, versus expected and the expected, right? If I just sum those two, I have a net right here. You'll see a net increase to my plan assets for 12,000. But this $1,410, rather than contributing volatility to the pension, to the earnings via the pension expense, we have a special, we're going to debit the OCI for gain losses, for these specific types of gain losses. And so notice, like with 2027, I've added this new column, right? We had this OCI related to prior service costs from rolling forward from 2026, but now in 2027, I've added this new column, also OCI, but specifically for the gain loss components. And we will need that if we need to record a corridor, to see if we have a corridor amount or versus what our accumulated OCI, we would do that only accumulate OCI related to gain loss. But that's going to be beyond the scope of this pension worksheet, but that's why it's important to separate the two OCIs within your worksheet. Okay, let's go to the next thing is funding contributions. The employer contributed $24,000. And so they're going to increase the plan assets for that amount and decrease the cash component. So we're going to have debit plan asset, credit cash. We have benefits that are paid to retirees, and that's right here on row 47. We know that when we pay the benefits to retirees, our projected benefit obligation will go down. So we have a debit to PBO, but the credit goes to plan asset. And then we have our prior service cost amortization from 2026, where we had to amortize that $80,000 prior service cost. So it's the same, it's going to be the same journal or the same amount each year, where we are going to debit the pension expense and reduce our OCI, or decrease the debit. So we're going to credit OCI prior service cost. So you can see our OCI was at a net OCI loss for prior service cost of 64, and now we've reduced the loss to 48,000. So you think, okay, maybe I'm done. But let's see, there's this one more further bullet point on row 14, and it says changes in actuarial assumptions resulted in an end of year projected benefit obligation of $265,000. So this is saying there has been some sort of change to the PBO, whether it's the interest rate that was used or the service life that was expected to be completed, or the retirees were going to retire for a different number of years. Whatever the case, it's a change in estimate. And they are now projecting the ending PBO at the end of 2027 is going to be $265,000. Well, this is, let's just look at this, ignore this 265 right now. That needs to be my ending balance. But let's look at my beginning PBO was 212. Then I had these 3 items hitting the PBO. And if I sum all those items, right? If I sum all those, where are they? Where's my sum? Oh, right here. It's very, very small. Right here, the sum of those items is $236,470 as a credit. And I know that my credit actually needs to be 265. So, which means that there's some sort of true up to the projected benefit obligation. And if I look at right here, right, here's my credit is the way without anything, not yet accounting for this true up, is 236,470. But it needs to be 265,000, which means that I need to increase my projected benefit obligation by $28,500. So here on this row 48, I'm going to credit my projected benefit obligation to 28,500, and then when I take my beginning balance plus my current year activity, then I get a sum of 265. Now that debit is going to go to OCI, attributed to gain loss, other comprehensive income. And again, important to keep the buckets separately. But now when I all done, these are all my transactions for the year, and I have my journal entry for the year, right? I have my P&L amounts are just what's in the current year, and here's my cash journal entry, and so on and so forth. Again, please look at the pension asset liability is really the sum of the projected benefit obligation plus the plan asset. So when I take those two accounts, it's a credit of 26,800. And so here I have the journal entry laid out by account. You can see we're looking at row 50 here is my journal entry, and that's what it's going to be. And then finally, when you're going to report it on your financial statements, you have to look at your ending projected benefit obligation, which is 265,000, and my ending plan assets is 159,600. So my net liability is 105,400, which again means I am underfunded. So this is, I'm not going to go through one more year, but this is how you do a pension worksheet. These are really important when you have multiple items going on, and the questions might ask you for certain balances or what's the net entry, to your OCI or to your projected benefit obligation. There's on the CPA exam, these might pop up, or it's really good to know how to do them so you can get answers for whatever question they're asking.